Process Costing at River Valley Paint Co., the ultimate deep dive. Slide 1, Meet River Valley Paint Co. Boom. Welcome to the Technicolor world of process costing people. I'm Dr. Anthony Fulmore, and today we're diving deep into a case study that'll revolutionize how you think about manufacturing accounting. Get ready for a full hour of mind-expanding knowledge that'll have you seeing the world through cost-tinted glasses. Let me introduce you to River Valley Paint Company, a family-owned manufacturer nestled along Oregon's pristine Deschutes River. These folks aren't just making paint, they're crafting liquid sustainability with their motto, color with conscience. 27 years ago, siblings Maya and Lucas Rivera were hand-mixing paints for local muralists out of their garage. Fast forward to today, they're shipping 60,000 gallons monthly to Homeshed and Evergreen hardware stores across the Pacific Northwest. But here's where it gets juicy. They're launching their new Earth Tone line this June, featuring rich hues made with recycled pigments. Game-changing stuff. But their rapid growth has created some serious growing pains in the mixing department. As their CFO, Elena Park, told me, we must know where every dollar goes inside that mixer. With premium sustainable pigments squeezing their margins razor thin, tracking costs isn't just good accounting, it's survival. This case study is perfect because it demonstrates how crucial accurate cost tracking becomes when a business is operating with slim margins in a competitive industry. When your materials cost more because they're eco-friendly, you need precision accounting to ensure you're still profitable without compromising your values. Slide 2, Process Costing Fundamentals. Now, before we dive into River Valley's specific situation, we need to establish some fundamentals. What exactly is process costing? Process costing is like financial GPS for manufacturers who produce homogeneous products in a continuous flow. It's like trying to track a single raindrop in a river. Impossible and pointless. Instead, we monitor the entire flow. Unlike job costing, which tracks unique custom orders like trying to follow individual passengers on a cruise ship. Process costing averages costs across similar units, moving through sequential processes, like following the current instead of the raindrops. Think about it. When you're pumping out thousands of identical gallons of sunset orange paint, you can't track each individual gallon's journey. That would be accounting madness. It would be like trying to name each kernel in a popcorn machine. Instead, you need a system that captures the flow of both physical units and costs through your production departments. The key concepts you need to understand are equivalent units of production, cost per equivalent unit, weighted average method versus FIFO method, and cost flows through sequential departments. You know what's wild? This same basic system has existed since the Industrial Revolution. The Egyptians probably could have used it for pyramid construction if they'd had better accountants. But for River Valley, this system allows them to accurately determine the cost of each gallon as it moves from mixing to packaging to distribution, just like a passport tracks a traveler through customs checkpoints. The fundamental distinction between process costing and job costing is absolutely critical. Process costing applies when products lose their individual identity in the production process. In River Valley's case, once those raw materials enter the mixing vat, you can't distinguish one gallon from another, they're homogeneous. Their production is continuous rather than discrete, flowing like a river rather than moving like separate boats. This homogeneity is what makes process costing not just appropriate, but essential for their business model. Slide 3. Mixing Department Snapshot, June. Let's zoom in on River Valley's mixing department for June. This is where the accounting rubber meets the road, folks. Check out these numbers. Beginning work in process on June 1st. 5,000 gallons, 100% complete for materials. They're already in the vat. Only 60% complete for conversion. Still need more mixing, heating, testing. It's like having a cake with all ingredients added but only partially baked. Started production on 37,500 more gallons during June, ending WIP on June 30th, 8,000 gallons, 100% complete for materials, only 40% complete for conversion. The costs added during June: a cool $120,000 in raw materials, $79,500 in direct labor, and $97,000 in overhead. Think of this department as River Valley's giant industrial blender. Some paint was half mixed on June 1st, more was poured in throughout the month, and 8,000 gallons are still swirling on June 30th. It's like a highway where some cars have traveled the full route, others just joined, and some are still in the middle. Our mission: track every single penny from raw goo to finished product. Remember my mantra: to learn accounting, you must do accounting. So let's do this. Let me point out something critically important here. Notice the percentage completion for materials versus conversion. In paint manufacturing, materials are typically added at the beginning of the process. That's why both beginning and ending inventory are 100% complete for materials. The conversion activities, mixing, heating, quality testing, happen continuously throughout the process, which is why the completion percentages vary. This distinction between materials and conversion is fundamental to understanding process costing. Also note that River Valley uses the weighted average method, which means we'll combine beginning inventory costs with costs added during the period to calculate a single average cost per equivalent unit. This is appropriate for their continuous production environment and is much more practical than trying to track FIFO, first in, first out, in a literal mixing vat. Slide 4, 5-step process costing approach. River Valley follows a 5-step approach that'll transform you from process costing novices to masters. This is like the black belt progression in accounting karate. Step 1, analyze physical flow of units. Track beginning inventory, units started, completed, and ending inventory, just like a nightclub bouncer keeps track of people entering and leaving. Step 2, calculate equivalent units of production. Convert those partially completed units into equivalent complete units. It's like counting 3 half sandwiches as 1.5 whole sandwiches. Step 3, determine total cost to account for. Some beginning WIP costs and costs added during the period, like totaling your checking account. Starting balance plus deposits equals what you need to account for. Step 4, calculate cost per equivalent unit. Divide total cost by equivalent units, just like calculating the cost per mile on a road trip. Step 5, allocate costs to units. Apply the cost per equivalent unit to finished goods and ending WIP, like distributing a restaurant bill based on what each person ordered. This isn't just River Valley's system, this is the blueprint for process costing success worldwide. I once consulted for a beverage company that skipped step 2, and let me tell you, their financial statements were a nightmare. It was like trying to make a cake without measuring the ingredients. Don't be that company. Now let's see how River Valley applies this methodology in their mixing department. The sequence of these steps is absolutely critical. You can't jump ahead or work out of order. For instance, you can't calculate cost per equivalent unit, step 4, until you know both your total costs, step 3, and your equivalent units, step 2. Similarly, you can't determine equivalent units until you've analyzed the physical flow, step 1. Each step builds upon the previous one, creating a logical progression that leads to accurate cost allocation. Miss one step or perform them out of order, and your entire costing system collapses. Many accounting errors occur not because people can't do the math, but because they don't follow the methodology systematically. Remember, discipline in following these steps separates successful cost accountants from the amateurs. Slide 5, Q1, Raw materials entry. Question: what journal entry records $120,000 of materials issued to mixing? The answer is Dr. Work in Process, mixing 120,000, CR raw materials, inventory 120,000. This isn't just numbers on a page, people. This entry tells a story. It's like the financial screenplay of materials moving through the factory. We debit work in process because those materials, those pigments, solvents, binders, now live in the mixing vat. And we credit raw materials inventory to show they've left the warehouse. It's like checking out of a hotel. You're no longer on their room list, but you've entered the city. The beauty of accounting is how it mirrors physical reality. Just as workers wheel those drums of crimson, azure, and emerald across the factory floor, our journal entry tracks this movement of value within the company. This, my friends, is financial poetry. Every journal entry is like a haiku of business activity, compact but full of meaning. This entry captures the moment potential becomes production, like an athlete moving from the bench to the playing field. Let's break down this entry in excruciating detail to ensure you truly understand what's happening. We're debiting work in process. Mixing, which is an asset account because we're increasing the value of the partially completed products in that department. We're crediting raw materials inventory, which is also an asset account, because we're decreasing the value of materials in storage. This entry represents the issuance of materials to production, not the actual usage or consumption of those materials. In some manufacturing environments, these could be different events, but at River Valley, materials are added at the beginning of the process. So issuance and usage occur simultaneously. Note that we're using a specific work in process account for the mixing department, which is essential in a process costing system that tracks costs by department. If River Valley had just one generic WIP account, they wouldn't be able to properly track the flow of cost through sequential processes. Slide 6, Q2, direct labor entry. Question: what journal entry records $79,500 of direct labor? The answer is Dr. Work in Process, mixing $79,500, CR salaries and wages, payable $79,500, labor. This is human effort converting raw goo into vibrant color. It's like the difference between flour sitting in a bag and bread baking in the oven. Human intervention creates transformation. The mixing, the testing, the quality control, all that sweat equity gets capitalized to work in process because it adds value to the product. Think of it like a sculptor's hands turning clay into art. The clay has value, but the sculptor's work multiplies that value exponentially. I once toured a paint factory in Michigan where the mixer operators could tell a batch was perfect just by the sound it made against the paddle. That specialized knowledge, that's what we're capturing in this simple journal entry. It's like recording the value of a maestro's baton movement, not just the cost of the orchestra's sheet music. In accounting terms, we're recording the cost of direct labor, the wages of employees directly involved in the production of paint. This includes the mixer operators, quality testers, and other workers who physically interact with the product. We don't include indirect labor like supervisors or maintenance staff. Those costs are part of overhead. By debiting work in process, we're saying this labor has added value to our inventory. By crediting salaries and wages payable, we're recognizing the liability to pay these workers. Notice we don't credit cash. That's because the actual payment typically happens later, on payday. This journal entry represents the incurrence of labor costs, not the disbursement of cash. The distinction between when costs are incurred versus when cash is paid is fundamental to accrual accounting. In a process costing system, we want to match labor costs with the production that benefited from that labor, regardless of when paychecks are issued. Slide 7, Q3, overhead, entry. Question: what journal entry applies $97,000 of manufacturing overhead? The answer is Dr. Work in Process, mixing 97,000, CR, manufacturing overhead 97,000. Overhead is everything else that makes production possible. The tank depreciation, the electricity powering those mixers, the factory supervisor's salary, the quality testing equipment. It's like the hidden part of an iceberg. Materials and labor are the visible tip, but overhead is the massive structure beneath that actually makes everything possible. You know what's fascinating? Many companies fail because they ignore overhead. They price products based on materials and labor alone, then wonder why they're losing money. It's like building a house but forgetting to budget for the foundation, roof, and plumbing. River Valley gets it right by applying overhead to WIP so each gallon bears its fair share of these indirect costs. Without overhead, you just have colorful puddles, not professional-grade paint. It's like the difference between ingredients in a bowl and a finished soufflé. The oven, the kitchen, the chef's training. That's all overhead, and it's essential. Now let's dissect the accounting mechanics of this entry. Manufacturing overhead is a control account that accumulates various indirect costs: depreciation, utilities, indirect labor, supplies, etc. Throughout the period, actual overhead costs are debited to this control account as they're incurred. Then, overhead is applied to production using a predetermined rate, often based on direct labor hours, machine hours, or some other activity driver. This entry represents the application of overhead to the mixing department's production. By debiting work in process and crediting manufacturing overhead, we're transferring those costs from the control account to the inventory account. At period end, any difference between actual overhead incurred and overhead applied creates either over-applied or under-applied overhead, which must be disposed of appropriately. This system ensures that every product bears a reasonable portion of the indirect costs necessary for its production, which is essential for accurate product costing and ultimately pricing decisions. Slide 8. Weighted average process costing. River Valley uses the weighted average method for their process costing, and there's genius in this simplicity. Think of weighted average like making a smoothie. You don't worry about which exact strawberry came from which package. You blend it all together and get an average of all those costs. Or consider it like mixing different temperatures of water in a bathtub. You don't get bands of hot and cold. You get one consistent temperature. The weighted average method combines beginning inventory costs with current period costs, calculates a single weighted average cost per equivalent unit, applies this average cost to all units completed or an ending WIP, simplifies calculations compared to FIFO method, and is acceptable under GAAP for financial reporting. It's like calculating your grade point average. You don't remember which specific study session contributed to which test score. You just average all your scores together. Let me tell you about Paint Pro Industries, a competitor who tried using FIFO for their 173 different color formulations. Their accounting department had a complete meltdown at quarter end. It was like trying to maintain separate grocery lists for each item in your pantry based on purchase date. For River Valley's homogeneous paint batches, weighted average is the perfect match. Adding complexity would just waste resources without providing meaningful information, like putting racing stripes on a school bus. Looks fancy, but doesn't improve function. Let me elaborate on why the weighted average method is particularly appropriate for River Valley. In paint manufacturing, the production process involves actual physical mixing of materials. Once raw materials enter the vat, you literally cannot distinguish between beginning inventory and current period additions. The weighted average method mirrors this physical reality by mixing the costs as well. The alternative, FIFO, assumes that beginning inventory is completed and transferred out first, followed by units started during the period. This would require tracking separate layers of costs and calculating separate equivalent units for beginning inventory and current period production, a needlessly complex approach that doesn't provide better information in a truly continuous process. Additionally, when costs remain relatively stable from period to period, the weighted average method produces results very similar to FIFO with considerably less computational effort. River Valley's management recognizes this and wisely chooses computational efficiency over needless complexity. Slide 9, Q4, units completed and transferred. Question: how many gallons were completed and transferred out? Let's work through the flow reconciliation. Beginning inventory, 5,000 gallons, started during June. 37,500 gallons, total in process. 42,500 gallons. Less ending inventory, 8,000 gallons, therefore completed and transferred. 34,500 gallons. This calculation is like taking attendance in a classroom. Count how many students were present at the beginning, add new arrivals, subtract those who are still there at the end, and you'll know how many left during the day. This physical flow is the foundation of our entire costing system. If we get this wrong, everything else collapses like a house of cards. It's like trying to balance your checkbook starting with the wrong opening balance. No matter how careful you are with additions and subtractions, you'll never reconcile. Remember my mantra: where the numbers speak, we must listen. And these numbers are telling us that 34,500 gallons completed their journey through the mixing department this month. It's like counting cars exiting a highway. We need to know exactly how many units moved through the system. This calculation represents step 1 in our process costing methodology, analyzing the physical flow of units. It's a simple equation based on conservation of mass. What comes in must either go out or still be there. Mathematically, it's beginning inventory plus units started equals units completed and transferred plus ending inventory. Rearranging to solve for units completed and transferred. Units completed and transferred equals beginning inventory plus units started minus ending inventory. This is known as a physical flow reconciliation, and it's absolutely fundamental to process costing. Without an accurate count of physical units flowing through the system, all subsequent cost calculations would be meaningless. Notice that we're tracking gallons, not dollars, at this stage. We're establishing the physical flow before attempting to track the cost flow. This is a crucial distinction. Units and dollars must be tracked separately, but in parallel. Some students mistakenly try to jump straight to cost calculations without first establishing the physical movement of units. That's like trying to calculate the cost of your road trip without knowing how many miles you drove. Slide 10, Q5, equivalent units for materials. Question: what are the equivalent units of production for materials? Answer: 42,500 equivalent units. Materials are added at the start of the process, so every gallon, beginning inventory, started during the period and ending inventory is 100% complete for materials. Think of it like making cookies. Once you add chocolate chips to the dough, every cookie will contain chocolate chips regardless of whether they're fully baked yet. Equivalent units equals units transferred out plus ending WIP. EU equals 34,500 plus 8,000 equals 42,500. This concept trips up so many students. It's like trying to count partially filled glasses of water. Do you count them as full glasses or not? Equivalent units give us the answer by converting everything to comparable units. Remember, equivalent units convert partially completed units into a standardized measure of fully completed units. For materials, that's easy because they're all 100% complete, like counting pregnant women as having one baby each, even though the babies aren't fully developed yet. But just wait until we get to conversion. Now we're moving to step 2 of our methodology, calculating equivalent units of production. This is a critical concept. that allows us to convert partially completed units into a standardized measure of fully completed units. For materials at River Valley, this calculation is straightforward because materials are added at the beginning of the process. Therefore, every unit in ending WIP already has 100% of its materials, even though the conversion activities aren't complete. Notice that we only need to consider units transferred out, 34,500, and ending WIP, 8,000 for this calculation. Beginning inventory and units started during the period don't directly enter the equation. They've already been accounted for in the physical flow reconciliation. The equivalent units calculation tells us the production volume to which we'll attribute costs. It's like calculating how many full meals were served at a restaurant, counting partially eaten meals as fractional equivalents. For materials, the equivalent units, 42,500, exceed the units completed and transferred, 34,500, because the 8,000 units in ending WIP already have all their materials. This relationship is crucial for understanding how costs flow through the system. Slide 11, Q6, equivalent units for conversion. Question: what are the equivalent units of production for conversion? Answer: 37,700 equivalent units. Now it gets interesting. Unlike materials, conversion happens throughout the process. Those 8,000 gallons in ending WIP are only 40% converted. It's like counting partially read books. If you've read 4 chapters out of 10, that's 0.4 of a book. So we calculate. Equivalent units from ending WIP. 8,000 times 40% equals 3,200 EU. Equivalent units from completed gallons. 34,500 EU. Total equivalent units for conversion. 34,500 plus 3,200 equals 37,700 EU. This is like a marathon where some runners have finished the full 26.2 miles, and others have only completed 10.5 miles. We convert to equivalent miles run to understand the total effort. This right here separates the accounting amateurs from the professionals. Understanding that partially completed units represent fractional equivalent units is the key to accurate process costing. It's like calculating the water in a swimming pool when some sections are deeper than others. You need to consider both area and depth. Now let's dissect this calculation in precise detail. For conversion, we need to consider the percentage of completion for units in ending WIP. The 34,500 gallons that were completed and transferred are 100% complete for conversion. They received all the mixing, heating, and testing required. But the 8,000 gallons in ending WIP are only 40% complete for conversion. This means they've only received 40% of the required conversion activities. In equivalent unit terms, these 8,000 physical gallons represent only 3,200 equivalent gallons of conversion effort, 8,000 times 40%. The total equivalent units for conversion, 37,700, are therefore less than the equivalent units for materials, 42,500, which reflects the reality that conversion activities are incomplete for ending WIP. Think about what this means. If we were to complete all the in-process units tomorrow, we'd need to perform 4,800 more equivalent units of conversion work, 8,000 times 60%, but add 0 equivalent units of materials work. This distinction is crucial for accurate cost allocation and for production planning. The weighted average method simplifies this calculation by ignoring the degree of completion for beginning inventory, assuming all units were at the same stage of production, like resetting the odometer at the beginning of the period. Slide 12, Q7, total materials cost to account for. Question: what total materials cost must be accounted for? Answer: beginning materials cost $16,000. Materials added during June, $120,000. Total materials cost $136,000. Every cent of this $136,000 must be traced to either ending WIP or finished units. It's like tracking every dollar you take on vacation. Whether you spent it or brought it back home, you need to account for all of it. This is the detective work of accounting, following the money trail through the production process. Like a CSI investigator tracking evidence, we must follow every dollar from entry to exit. I once consulted for a company that lost $23,000 of material costs between departments. Turned out they were recording scrap as an expense instead of building it into their process costing system. It was like counting passengers who boarded a cruise ship but forgetting to count those who got seasick and stayed in their cabins. Don't make that mistake. Every penny that enters the system must be traced to its final destination, like following a drop of dye through the bloodstream. It has to end up somewhere. We've now moved to step 3 of our process costing methodology, determining total costs to account for. This represents all material costs that entered the mixing department during June, including both the materials cost of beginning WIP, $16,000, and materials added during the period, $120,000. It's crucial to understand that the $16,000 represents the cost of materials in the 5,000 gallons of beginning WIP, not the total cost of beginning WIP, which also includes conversion costs. In the weighted average method, we combine beginning inventory costs with current period costs before calculating cost per equivalent unit. This reflects the physical reality that once materials enter the mixing vat, they become indistinguishable. Where did these numbers come from? The $16,000 beginning materials cost comes from the previous period's ending inventory valuation. It's a carried forward figure. The $120,000 of materials added comes from the raw materials requisitions recorded during June, as reflected in the journal entry we analyzed earlier. These costs are pulled from the general ledger accounts and supporting schedules. The total materials cost, $136,000, must equal the sum of materials cost assigned to units completed and transferred plus materials cost in ending WIP. This is the cost reconciliation we'll verify later. Slide 13, Q8, total conversion cost to account for. Question: what total conversion cost must be accounted for? Answer: beginning conversion cost, $12,000. Direct labor added, $79,500. Overhead applied, $97,000. Total conversion cost, $188,500. This represents the total pot of conversion costs that will soon be allocated between completed gallons and partially mixed ones. It's like a buffet where some diners take full plates while others take partial servings. But you need to know the total cost of all food prepared. You know what's wild? The conversion costs are higher than the material costs. That's common in modern manufacturing. The value is increasingly in the process, not just the raw materials. It's like a gourmet restaurant where the ingredients might cost $15, but the chef's preparation justifies a $75 price tag. This is why we need to be so meticulous in our tracking. The value added through processing often exceeds the cost of the inputs themselves, like the difference between flour, eggs, and sugar versus a wedding cake. Understanding this cost relationship is critical for pricing and strategic decisions at River Valley. Just as we did with materials, we're determining the total conversion cost to account for. This includes the conversion cost in beginning WIP, $12,000, plus all conversion costs added during the period, $79,500 labor plus $97,000 overhead, $176,500. The $12,000 beginning conversion cost represents the value of mixing, heating, and testing that had already been performed on the 5,000 gallons in beginning WIP. Remember, these units were 60% complete for conversion, so this $12,000 represents 60% of the conversion cost that would be required for 5,000 gallons. The additional conversion costs come from direct labor, $79,500, and applied overhead, $97,000, which we recorded in the journal entries we analyzed earlier. The total conversion cost, $188,500, exceeds the total materials cost, $136,000, by $52,500. This cost relationship provides valuable information for management. It suggests that process optimization, improving the efficiency of conversion activities, might yield greater cost savings than negotiating lower materials prices. It also indicates that if River Valley experiences production problems that require rework, the conversion cost of that rework will exceed the materials costs. This insight helps prioritize quality control measures and process improvements. Slide 14, Q9, Cost per equivalent unit, materials. Question: what is the cost per equivalent unit for materials? Answer: $3.20. Calculation: $136,000 divided by 42,500 euros equals $3.20. This means each equivalent gallon consumes $3.20 worth of pigments, solvents, and fillers. $3.20 of colorful chemical magic in every gallon. It's like knowing exactly how much gold goes into each Olympic medal or how much coffee is in each cup at your favorite cafe. For River Valley, with their eco-friendly focus, this number reflects their commitment to quality and sustainability. Their premium recycled pigments cost more than conventional alternatives, but it's central to their brand promise. This is like organic produce costing more than conventional. The extra cost aligns with the company's values and market positioning. This material cost becomes a fundamental building block for all subsequent analyses. Like the atomic weight in chemistry, this number will be used repeatedly in our calculations. Understanding this unit cost helps River Valley compare their efficiency against industry benchmarks and their own historical performance. We've now reached step 4 of our process costing methodology, calculating cost per equivalent unit. For materials, we take the total materials cost to account for $136,000 and divide by the equivalent units for materials, 42,500, to get $3.20 per equivalent unit. This represents the average materials cost per gallon of paint, regardless of whether the gallon is completed or still in process. The weighted average method combines all materials costs, both from beginning inventory and current period additions, and spreads them evenly across all production. This simplifies the calculation, but also means that any cost fluctuations during the period are smoothed out. If materials prices increase significantly in late June, for example, that increase would be averaged across all production rather than specifically assigned to late June production. The $3.20 per equivalent unit becomes a crucial figure for River Valley. It's a key component of product costing, a benchmark for purchasing efficiency, and a foundation for pricing decisions. If River Valley knows their competitors' paint costs $3 per gallon in materials, they can evaluate whether their 20-cent premium delivers sufficient value to justify the higher price to consumers. This kind of competitive analysis is impossible without accurate process costing. Slide 15, Q10, Cost per equivalent unit conversion. Question: what is the cost per equivalent unit for conversion? Answer: $5. Calculation: $188,500 divided by 37,700 equals $5. Stirring, heating, testing, and overhead add $5 of conversion cost per equivalent gallon. It's like calculating the labor and overhead cost per burger at a restaurant. Beyond the meat and bun, what does it cost to cook and serve it? Think about that. The process of transforming raw materials adds more value than the materials themselves. It's like a sculptor transforming a $50 block of marble into a $5,000 statue. The real value is in the conversion process. This is why companies obsess over operational efficiency. Small improvements in conversion processes can yield massive savings when multiplied across thousands of units. It's like saving 10 seconds per traffic light in a city, individually small but transformative across millions of cars. This conversion cost contains the secret to profitability for many manufacturers. Cutting material costs might compromise quality, but optimizing conversion often improves both efficiency and quality. Just as we did for materials, we calculate the cost per equivalent unit for conversion by dividing the total conversion cost, 188,500, by the equivalent units for conversion, 37,700. The result, $5 per equivalent unit, represents the average conversion cost required to transform raw materials into finished paint. Notice that the conversion cost per unit, $5 was ours, exceeds the materials cost per unit, $3.20, by $1.80, or about 56%. This ratio is significant for management decision-making. For example, if River Valley is considering automating part of their mixing process, they should focus on the conversion activities with the highest labor content, as that's where the greatest savings potential exists. If they're considering a price increase, they might explain to customers that their premium price reflects not just better materials, but also a more thorough mixing and quality testing process. The $5 figure encompasses all conversion costs, both direct labor and manufacturing overhead. It includes mixer operators' wages, quality testers' salaries, depreciation on mixing equipment, factory utilities, production supervisors' salaries, and all other indirect manufacturing costs allocated to the mixing department. By calculating a single comprehensive conversion cost per unit, River Valley can simplify their decision-making while maintaining accurate cost information. Slide 16, Q11, Total Ending YP Cost. Question: what is the total cost of the 8,000-gallon ending whip? Answer: $41,600. Materials: 8,000 euros times $3.20 equals $25,600. Conversion: 3,200 euros times $5 equals $16,000. Total: $41,600. This $41,600 represents River Valley's investment in inventory that will be completed in July. It's like money in the bank, or more accurately, money in the VAT. It's the accounting equivalent of a "to be continued" caption at the end of a TV episode. There's value there that will be realized in the next period. The precision here is beautiful. We're not just slapping a generic in-process label on these gallons. We're calculating exactly what's been invested in them so far. It's like tracking the progress of a construction project. You wouldn't value a half-built house at zero or at full value. You'd calculate exactly how much has been invested at that point. This level of precision enables meaningful month-to-month comparisons and prevents the artificial shifting of costs between periods, like measuring your weight loss progress day by day, rather than just noting your start and end weights. Now we're implementing step 5 of our process costing methodology, allocating cost to units. For ending WIP, we apply the cost per equivalent unit to the appropriate number of equivalent units in ending inventory. For materials, that's 8,000 EU, since materials are 100% complete, multiplied by $3.20 per EU, giving us $25,600. For conversion, it's 3,200 EU, 8,000 gallons at 40% completion, multiplied by $5 per EU, giving us $16,000. The total ending YP cost is therefore $41,600. This valuation will appear on River Valley's balance sheet as part of inventory. It represents costs incurred that haven't yet resulted in finished goods, but will contribute to production in the following period. The detailed breakdown between materials and conversion provides valuable information for production planning. For example, if River Valley faces a sudden surge in demand, they know that these 8,000 gallons already have all their materials, $25,600 worth, but need an additional $24,000 of conversion work, $4,800 remaining EU x 5 to complete. This granular understanding of partially completed inventory helps managers make better decisions about resource allocation, production scheduling, and capacity planning. Slide 17, Q12, Ending WIP Cost Detail. Question: break the ending WIP cost into materials versus conversion. Answer: materials, 8,000 euros times $3.20 equals $25,600. Conversion, 3,200 euros times $5 equals $16,000. Total, $41,600. Materials on the left, conversion on the right. This breakdown shows how partially converted costs accumulate by element. It's like a fundraising thermometer that shows both pledges and actual collections. You need to see both components to understand the full picture. And notice something fascinating. The materials are at $25,600, while conversion is only $16,000. That's because these gallons are 100% complete for materials, but only 40% complete for conversion. It's like a novel that's fully researched but only partially written. All the raw material is there, but the creative transformation is still in progress. The ratio tells us exactly where these gallons are in their production journey. This detailed breakdown gives River Valley's production managers vital information about where their inventory stands, like a doctor looking at both temperature and blood pressure to diagnose a patient's condition. Without separating these costs, managers would have an incomplete view of their production pipeline. This slide might seem redundant after the previous one, but it emphasizes a crucial point. In process costing, we must track materials and conversion costs separately. This separation preserves important information about the cost structure and the production status of inventory. The material conversion split for ending WIP, 62% materials, 38% conversion, differs from the split for the cost per equivalent unit, 39% materials, 61% conversion, because ending WIP units are only partially complete for conversion. This relationship is a direct result of River Valley's production process, where materials are added at the beginning while conversion happens throughout. The detailed cost breakdown serves multiple purposes beyond financial reporting. It helps production managers plan completion of WIP, assists purchasing managers in forecasting material needs, and enables financial managers to analyze the company's investment in different categories of inventory. In a manufacturing business like River Valley, where inventory represents a significant portion of assets, this granular understanding of inventory composition is essential for effective management. Without it, decision makers would be operating with incomplete information, like trying to navigate using a map that shows only half the terrain. Slide 18, Q13, Cost of Units Transferred Out. Question: what is the total cost of the gallons transferred to finished goods? Answer: materials, 34,500 times $3.20 equals $110,400. Conversion, 34,500 times $5 equals $172,500. Total, $282,900. This $282,900 is the cost that leaves the mixing department and enters finished goods inventory for June's production. It's like graduates moving from high school to college. They've completed one phase and are moving to the next. It represents the complete cost of those 34,500 gallons, every drop of material, every minute of labor, every kilowatt of power used to transform raw ingredients into vibrant, eco-friendly paint. This transfer is like a relay race baton pass. The mixing department hands off completed units to the next stage, having added all the value it can add. The transfer represents the total production cost of completed units moving from manufacturing to inventory, ready for sale. It's like the final price tag attached after all manufacturing costs have been accumulated. The full cost to produce those gallons before any selling or administrative costs are added. This number becomes critically important for River Valley's financial statements and for calculating gross margin when these units are eventually sold. Continuing with step 5 of our process costing methodology, we're allocating costs to units transferred out. The calculation is straightforward. We multiply the cost per equivalent unit by the number of equivalent units transferred. Since completed units are 100% complete for both materials and conversion, the equivalent units equal the physical units, 34,500. For materials, 34,500 euros times $3.20 equals $110,400. For conversion, 34,500 euros times $5.00 equals $172,500. The total cost transferred is therefore $282,900. This figure represents the manufacturing cost of June's production output. It will either be transferred to another processing department, like packaging, or moved directly to finished goods inventory, depending on River Valley's production flow. Note the cost composition: 39% materials, $110,400, and 61% conversion, $172,500. This ratio is identical to the ratio of cost per equivalent unit because completed units are 100% complete for both elements. The $282,900 will eventually become part of the cost of goods sold when these gallons are sold to customers. At that point, River Valley will match these production costs against sales revenue to determine gross profit. The accuracy of this figure is therefore critical for financial reporting, profitability analysis, and strategic decision-making. If it's understated, River Valley might price their products too low. If it's overstated, they might lose sales to competitors with more efficient production processes. Slide 19. Q14. Transfer journal entry. Question: what entry moves the cost from WIP mixing to finished goods? Answer: Dr. Finished Goods 282,900, CR work in process, mixing 282,900. This entry closes out mixing WIP and opens its next life account, finished goods. It's like a graduation ceremony for those 34,500 gallons of paint. Just like changing the location tag in a museum, when artwork moves from one gallery to another. The accounting system tracks this movement perfectly. Just as physically those gallons are pumped to the packaging department or finished goods storage, our accounting system follows this movement with precision. It's like GPS tracking for value. We know exactly where each dollar resides at all times. The physical and financial flows are in perfect harmony. This is where accounting becomes a mirror of operations. The books reflect the physical reality of production flow, like a financial shadow that follows the actual inventory throughout the facility. This synchronization between physical and financial records is the ultimate goal of a well-designed accounting system, like the perfect harmony between lyrics and melody in a hit song. Now let's examine the implications of this journal entry in detail. First, notice that we're transferring the entire cost of completed units, 282,900, in a single entry, even though that cost comprises both materials and conversion elements. While we track these elements separately for analytical purposes, the transfer entry combines them because the units are now complete products. Second, this entry affects two asset accounts. It decreases work in process and increases finished goods. There's no impact on the income statement because we're simply moving costs from one inventory account to another. The actual expense recognition, cost of goods sold, will occur later when these units are sold. In River Valley's specific case, if they have multiple processing departments, this entry might actually debit work in process, packaging rather than finished goods. The completed output from mixing becomes the input for packaging, with additional costs added in that department. This creates a chain of transfers that mirrors the physical production flow, with each department adding value before passing the product to the next stage. The precision of this tracking ensures that costs follow products through the production process, providing the foundation for accurate product costing and ultimately informed pricing decisions. Slide 20. Q15. Cost reconciliation proof. Question: prove that total costs to be accounted for equal costs accounted for. Answer: costs to be accounted for. Beginning WIP $28,000, costs added $296,500, total $324,500. Costs accounted for, ending WIP $41,600, transferred $282,900, total $324,500. This is the moment of truth. When these two columns balance at $324,500, our process costing system is validated. It's like the perfect balance on a scale. The inputs on one side exactly match the outputs on the other. Every dollar that entered the department is traced either to inventory still in process or to goods that advanced. It's like balancing your checkbook. The opening balance plus deposits must equal withdrawals plus ending balance. This reconciliation is more than just a mathematical check. It's proof that our accounting system is capturing economic reality. It's like confirming both your odometer and gas gauge agree with your trip calculations. When multiple measures align, you know you're tracking correctly. When the numbers balance, our costing story is complete. This matching of total debits and credits is the foundation of accounting integrity, like making sure every guest who enters your party is accounted for when calculating how many slices of cake you need. Let's break down this reconciliation in excruciating detail to ensure you understand its importance. On the left side, we have the total costs to be accounted for. Beginning WIP, $28,000, which combines the $16,000 materials cost and $12,000 conversion cost we identified earlier, plus costs added during the period, $296,500, which combines the $120,000 materials, $79,500 labor, and $97,000 overhead we recorded in our journal entries. This totals $324,500, every dollar that entered the mixing department during June. On the right side, we have the costs accounted for, ending WIP $41,600 as we calculated earlier, plus costs transferred out, $282,900 also calculated earlier. This also totals $324,500, every dollar that either remained in the department or moved forward in the production process. The fact that these totals match confirms the accuracy and completeness of our process costing system. It verifies that we haven't lost any costs in our calculations and that our cost allocations are mathematically sound. This reconciliation provides assurance to River Valley's management and external auditors that the inventory valuations on the financial statements accurately reflect the costs incurred. It's the final step that validates our entire process costing methodology, closing the loop between the costs that entered the system and the costs that either remained in inventory or moved forward to the next stage. What we've just witnessed is accounting at its finest, providing crystal clear insight into the complex world of manufacturing. For River Valley Paint, this system delivers three critical benefits. First, accurate product costing. Knowing that each completed gallon costs $8.20, $3.20 materials plus $5 conversion enables precise pricing decisions that maintain profitability while staying competitive. It's like a chef knowing the exact food cost of each dish before deciding on menu prices. Second, production efficiency analysis. By separating materials from conversion costs, management can identify opportunities for improvement in each area. It's like a doctor running different tests to pinpoint exactly which system in your body needs attention. Third, strategic planning support. As River Valley launches their new earth tone line, this detailed cost data will help them evaluate whether the recycled pigments truly reduce material costs or if additional processing increases conversion costs. It's like a GPS offering alternative routes before you commit to a journey. Remember what CFO Elena Park said, "We must know where every dollar goes inside that mixer." Through the power of process costing, River Valley now has that knowledge, allowing them to balance their commitment to sustainability with financial viability. Where the numbers speak, we must listen. And process costing gives us the language to understand what they're saying. This is Dr. Anthony Fulmore, signing off. Next time, we'll explore how River Valley's costs flow to the packaging department, where the drama and the accounting gets even more intense. Boom.